very important thing that people don't seem to really understand. You're using long-term care to protect your other assets, to protect, from your, estate, and to be able to, move on your wealth to your children, and pass it on like that. That's one, and we also, big thing is call it, private funding. You're funding your own, health. You're funding your own, with the long-term care, if you're getting it or not, but same thing. And that seems to go a long way, is how they use long-term care, not just for your health, but to protect your other assets. Because those assets can go away very quickly when you're paying $200,000 a year to be in a facility, or somewhere. And you might be there for a while. Again, my grandmother, I'm Italian, 84 years old, congestive heart failure. She's been in a long-term care facility. Started out at $120,000. Now it's like 200 and something, because the increase on those are ridiculous. It's 7, 8, 9%. She had a long-term care policy and paid out, I don't know, $1.4 million. Anyway, you got to pass the 5-year mark. So, and also, that's another thing that we should talk about within a trust. You want to be able to pass that 5-year mark. So at least having enough long-term care to get you past that part to protect your other assets as well. She is now 96 years old, still in congestive heart failure, still alive. These old people, they don't die anymore. I think the average used to be a long-term care facility 2 years. Now that is like quadrupled. So just to add on into extenuate your point on the need for this long-term care.
Yes, and so I'm glad you bring that up, because what can happen here is, even if you have the asset set aside, it's growing so fast, it might not keep up with your wealth manager's ability from a risk standpoint. The other thing I think of is, Joe, to your point, was Grandma, was she cared for at home for a bit before she needed that kind of care?
Yes.
So what happens here a lot of times, guys, is when people get sick and injured, it's at a particular time that person might still be working. And so caring for that person logistically isn't able to be done. Or number two is, I'll use my mom as a good example. She's 100 pounds. She's tiny. So if, let's say, she had to take care of somebody that was larger, that would be very difficult physically for her. So she might not have the physical ability even to care for that person if they need that kind of care. The kind of the sadder ones that we run into is, of course, those that have Alzheimer's or dementia, and their personality changes, and now they're nasty. They forget. They're scared of being with their own child because they don't remember this person. And so sometimes putting that person in a facility is better for their own mental state, because they're fearful of where they are, because they don't remember where they are. And so there's a variety of different situations that occur. And so it becomes important for us to audit your retirement and make sure that we're protecting, right? Because that's the risk management business that we're in. We're protecting your retirement. And so even if you tell me that, hey, culturally, I'm going to take care of my mom and dad if they get sick or injured, and that's the case. And my mom lives not too far down the road. Well, it's like not down the road. It's like 45 minutes away, or 40 minutes. It could totally be, hey, she gets sick or injured. She needs care at the house. Just come on over. We'll take care of you, right? Still need to have that conversation. Still want to talk that through. Still want to have that plan. Now, the nice thing about it is long-term care has a variety of different options. You can have life insurance with a long-term care rider at no cost, right? National Life has a phenomenal pseudo long-term care with those 4 accelerated benefits that we talked about before, right? You also have annuities with a long-term care option. You have standalone long-term care. And so there's a lot of different options that we can set up for clients to help protect against that. And then, just so you know, if a client has a policy and the insurance company is trying to buy it out, they should never sell it. That means they won. they beat the insurance company's actuaries. They aren't the insurance company can't raise premiums fast enough for the benefit that they gave out. So you run into that quite a bit with those that have took some responsibility. But this becomes really Jake, this only happens if I'm talking to people 60 years old and older, right? So if I talk to Lando, what's the average age of person you're talking to from a prospect perspective?
As far as for a client?
Yeah, as far as the client.
Man, for me, right now, anywhere between 30 and 40.
Okay, so long-term care is probably not even on the horizon of the majority of those individuals, right? But Joe, you have a practice from dad and uncle. How many of yours are probably over the age of 60?
Yeah, all of them.
All of them, right? So he has
My clients, they're all over the age of 60, 65.
right? And so this becomes a very big conversation, right, for him and his practice. So just understand that. At the same time, disability, Joe might go, if all my people are over 60, I'm going to talk to 0 of them about disability, but I'll talk to 100% of them about this. Because the last thing I want to have is that daughter to call me and go, you did no planning for my parents for this, and now they're in a home. I'm going to sue you because I know you have errors and omissions because I'm an attorney that does elder law. Right? So that's kind of where, for me, this is about, disability is about 55 and under. Long-term care for me is 55 and up, and even 50. The youngest client I actually sold long-term care to was actually last year, and is because he was dealing with, him and his wife were dealing with his parents and paying for long-term care, and he's like, I'm super healthy. He was 43 years old and bought himself a freaking Cadillac policy, and it was like $200 a month. It was insane. We basically maxed out the monthly benefit, maxed out till age 65, and we ended up not doing inflation because we maxed out the monthly benefit to like 15 grand or something ridiculous. So that's kind of where you want to have a look at this. Johnson's very comfortable in long-term care. When we start having these conversations, there's a variety of different ways you want to take it, standalone, combo products. There's ways to be able to make sure that it's feasible for the client. So everybody that thinks it's expensive was only sold something that was expensive, right? There's very few risks that we take when it comes to insurance, that we take 100% of that liability and we give it to the insurance company.
Mm-hmm.
So in other words, if I'm just planning for 3 years of a potential stay, that means I only need a benefit that covers that little duration. I don't need to get the entire Cadillac, or Cadillac's not even a good company anymore. I don't need to do the entire Mercedes-Benz of Ferrari of long-term care policies if I'm only going to look at this small little risk.
And,
Johnson.
yeah, and really, what you'll find in the long-term care space is that people that have dealt with long-term care with their families, their parents, understand how important this stuff is, right? Youngest person I ever sold to is actually the people that own Vince Young's in Austin. They're like 35. They both got policies from me. But long-term care, really, when we look at the costs, right, we talked about it exponentially increasing every single year.
Okay.
The median cost for an average, run-of-the-mill average long-term care nursing care facility up here in New York is about $13,000 a month, right?
Yeah, and even in Houston with our our undocumented, it's still like 9,500, right? So it's still crazy expensive.
Right, and it's going up everywhere. So the way that I really like to sell and look at long-term care is as portfolio protection, right? I use that word when I'm talking to clients because it makes them really understand what we're looking to accomplish with this planning, right? So when you talk about the cost of long-term care, talk about the longevity that is potentially there with long-term care, right? Especially if we talk about something like early onset dementia, where you're getting diagnosed with early onset dementia at, let's say, 50 years old. Over the next 5-10 years, that's going to be a very prevalent thing in regards to the disease, the progression of that disease. We're talking about 10, 15 years potentially in these long-term care facilities. So The idea here is that we're looking at it for portfolio protection. I'm looking to come in and maybe I don't cover the entire cost of long-term care. Let's use $12,000. I don't cover the entire monthly cost of long-term care, 12 grand. But if I can come in and get, let's say, 6 grand, 8 grand, 10 grand worth of long-term care benefit for, like Sherman said, potentially pennies on the dollar, then I'm covering a decent chunk of that portfolio, of their asset portfolio, right? Now, mom and dad don't have to burn through their assets to cover the cost of care. And then what happens when people burn through their assets? The kids now becomes a burden on the kids. So the idea is to at least protect a portion of this with tax-free money, tax-free benefit to cover that cost of care. And the only other thing I would say, guys, is we do not typically sell standalone long-term care here. Big reason for that is there are no guarantees in the contract. So what I mean by that, the long-term care benefit's not guaranteed, the premium's not guaranteed. Carriers have the right to come back each and every year with standalone policies, standalone long-term care policies, and ask for an increase or request an increase of premium from the state. State grants it, they reverse that back to you. And when you get that letter in the mail that says they're increasing their premium, they really give you 3 options. Pay the increased premium for the same benefit, you reduce your benefit and pay the same premium, or what they're really looking for you to do is cancel your policy, don't get any money back, you just gave them X amount of dollars over X amount of years, and now you have nothing to show for it.
Can I add to that?
Please.
Yep. So 40% increase in premiums. This is what they've been coming back with. 40% increase. Now these are people now, let's say if they got it when they're 60, now they're 70, they're on fixed incomes. They want them to pay 40% more, for the same benefits. And you're right. Sometimes they'll do, if the law was passed, usually they'll give them whatever they paid in premium is now their new benefit per dime. So if they paid in $80,000 and they had a $300 a day benefit, that's it. Now your long-term care is just whatever you paid in. You lost everything you thought you were going to get, with it. And you're talking about audits. This is something that should be, if someone has a long-term care policy, you have to audit it. Because it's almost 100% positivity, especially in New York. That premium has been going up on that policy for that class. At least 40%.
Yep, and I've seen a mutual of Omaha contract.
Yeah.
120% increase.
Yeah, it's just illegal.
$200 this year, he's paying $2,200 next year. So what we look to do is we look to add either it as a rider. So like Sherman said, we can utilize it as a life insurance policy and add a dollar for dollar long-term care rider.
On the IUL?
Say it again?
We have this on the IUL?
We have this on the IUL, GUL, current assumption UL, guaranteed variable universal life. Every policy we sell, we can add it to. And then on the back end, I'm sorry, I lost my train of thought. And the reason for that, guys, is with standalone long-term care, right? If I don't ever need access to long-term care, God willing, I pass away at age 90 from old age. I paid all this money in with nothing to show for it. It's what we call a use it or lose it scenario.
Right. Fire insurance.
By attaching it to a life insurance policy, I pass away, boom, policy pays out to my family. I need access to long-term care, boom, I'm taking a dollar for dollar reduction off the death benefit, all comes out tax-free. The second way we can sell this is what we call or the annuity. So ForCare has a really interesting annuity that we can sell long-term care with. Client puts in, it's for unhealthy people. So client puts in $100,000, they're going to get a 2 or 3x depending on health. So let's say they get the 3x option, they're going to have $300,000 of long-term care benefit. Third option, standalone, we talked about that. There's actually a fourth option that they call hybrid plans. So hybrid long-term care plans. They work a little differently. So this is a more long-term care focused than life insurance focused. So large long-term care pool, small death benefit, fully guaranteed contract. So we don't have premium increases, and it works just like you would assume it works, right? You need access to care, it pays out.
So sometimes you see those as like a single premium. So hey, I put $100,000 in. It gives me a death benefit of $250,000, but it gives me a pool of long-term care of $300,000, right? So basically, you're getting 2.5 times. Now it is automatically a MEC because it's a single premium life policy. You can get different options, right, where it's a monthly one, but sometimes you see those as these hybrids. The long-term care, the life of long-term care rider, there's no factoring, right? So let's say Johnson's point, it's $1 million of life insurance death benefit. Your long-term care, you can take a portion of that 1 million and pay it out as long-term care if you satisfy those two activities of daily living. Okay, so that's really where there's these differentiators, and the reason why you see all these different options is because, to Johnson's point, there's not been an insurance company out there that's come out with a policy that hasn't had to increase premiums. Northwestern Mutual is probably one of the largest life insurers to finally come into the game, and they waited till 2006 or 2008 to actually come out with the policy, and even they have had to change premiums. This is a huge liability to MetLife and to John Hancock. They both had huge blocks of long-term. So Genworth as well. When GE sold Genworth, the big chunk of that was because of this long-term care liability that was out there on that block of business, because it's viewed as basically debt in the insurance world.
Massachusetts Mutual, their big thing was, we're the best, we'll walk there, we never raise our premiums. Yeah, guess what? As soon as we had to raise it, we actually just got rid of all the long-term care, can't offer it anymore. So no one saves from that.
Can't say we didn't raise it anymore. Let's just stop selling this thing. Okay.
That's right. Yeah, it's unbelievable. Quick question. Quick question. I can't believe this even exists anymore. Do they still offer? Is anyone still offer indemnity plans? If I'm not aware of any, I could sell.
So yes, so that's a great question. I don't know if we talked about it yet, but there's two ways that long-term care pays out. First is indemnity. Second is reimbursement. Reimbursement is exactly what it sounds like. In the event that you go on claim, client pays out of pocket for services, submits receipts to the carrier, and the carrier reimburses them. Not the way we want to sell it. The carrier can reject your long-term care. Don't have let's say a registered long-term care nurse come to your house to take care of you. That first month you're completely out of pocket, you have no idea, you submit the receipts, they come back and say, hey, sorry, this doesn't qualify, you gotta go find someone else.
Yeah.
The indemnity contracts, and yes, Joe, we can sell indemnity, that's the way we look to sell long-term care, is you go on claim as a client, there's an elimination period with long-term care, 90 days, just like with disability. After that 90-day period, the carrier is writing you a check for your monthly benefit at the beginning of every month. They send it to your house, they direct deposit into your account. You can then use that money at your own discretion.
No restrictions.
With indemnity contracts, so really the way we want to sell it for a couple reasons, obviously out of pocket, not great for the client, right? Waiting to get reimbursed, not great. Getting turned down by the carrier, not great. But with indemnity contracts, spousal care counts under their debt.
Yeah, that's right.
So to Sherman's point he was talking about earlier, I need access to long-term care. My wife takes it on because it's not that difficult yet. My wife starts helping me. We can start cashing that policy in, use it to pay, let's say there's a mortgage on the house, keep the lights on, groceries, etc. Things get more severe, we need a nurse to come in, that's covered. We move into an assisted living facility, that's covered, check at the beginning of every month. Why go into a 24/7 care facility, really kind of hands-on stuff if I can't, I can't shoot food anymore, whatever that looks like. That's also covered. So we always want to look at the indemnity contracts for long-term care.
Johnson, who offers indemnity still? Again, this goes back to amazing that this has been taken off the table for me 9 years ago. And the fact that now I can offer it again is amazing.
AIG, Nationwide is my favorite long-term care carrier. Securian offers an indemnity contract, Credentials indemnity, Protectives indemnity.
Amazing.
I'm sure there's a few others. Your typical reimbursement carriers, John Hancock, Lincoln, National Life is an indemnity contract, so that pays out at the beginning of every month with their ABRs. Not a true long-term care rider, but the chronic illness rider is close.
Sure.
Simple, very similar, same qualifications, just a different payout structure.
Amazing.
Yeah.
Wow. It's gonna be nice working for you guys, I gotta say.
We're excited for it, brother.
The nice thing is that Breakthrough Insurance Group, BIG, that we showed you yesterday, who we partner up with on disability, long-term care, annuities, that's their backbone. Since basically long-term care has been in existence, so about 20 some odd years, I think BIG's been in existence. That's their specialty is long-term care. So they have, so you talk to Tim Kelly, that's all they did with brokers, wholesalers, is educate on long-term care. So if you have an opportunity or conversation, so Joe, I would definitely reach out to Tim Kelly, schedule some time to get with that team. That's all they did. And so now just Joe and Tim ended up buying over the business, rebranding it to Breakthrough Insurance Group, BIG. And so now they're focusing on disability and annuities. So it's going to give you a huge breadth of opportunity to be able to serve those clients in a way that makes sense, right? So I think when you have more tools to work with in this aspect of risk, it definitely helps. David asked a question: can children buy this on parents? And absolutely they can. So long-term care is one of the only insurance policies I know of that actually has a payer. I'm going to say a payer beneficiary, but it's not a beneficiary. It's basically someone that gets notified if premiums aren't paid. Because the reason is that's usually one of the first triggers that something's not happening right, is that the premiums don't get paid by this person because something happened in their banking information and they forgot to tell the insurer. And so this allows to make sure that this policy doesn't get lapsed on.
Yeah, in my part, that's becoming very, very big and almost mandatory now, and especially in the investment side of it, having a secondary, person, to receive your information. Actually, right now, I don't even think I can write a broker contract without it, unless they actually have to sign for opting out. So, yeah.